Hello, Steve. Hello, Josh. Hello,
Yeah,
Steve.
how are you, Evandro?
Very good. Thank you.
Hello.
Thank you very much for your time, for giving us the chance of hearing from two of the world's largest financial institutions your views on crypto, on this fantastic universe of crypto. As you probably know, this is a very special week for crypto in Brazil, and I guess in a way for the world, right? Because we had the beginning of trading of our first crypto ETF here on B3. We were directly involved in that project. And given that it was a huge success, you might have heard, right? We have, in less than a week, it's approaching already 1 billion reals of assets under management inside the ETF, more than 30,000 investors. So it's a huge success. I think it proves the point that the crypto instruments also belongs to the regulated environment. Let's put it this way. And with that, I would start asking Steve. Steve, I heard that yesterday the SEC once again delayed its final decision on whether or not it will approve or disapprove the listing of crypto instruments in the United States, right? I think there are more than 10 Bitcoin ETFs that are already filed, right, with the SEC, and we still don't know whether these things will go ahead or not. What are your views on that? When we finally gonna have a crypto instrument, a Bitcoin ETF traded on a major exchange in the United States, and overall, what are other possible milestones for the industry in the American market?
I think that's a great question. If I had a clear answer to that timing of when an ETF might be approved, I would probably be a very, very rich and highly sought after person. Of course, when we look at any new financial innovation, there's bound to be a structure in place from a regulatory lens that needs to be in place first before larger institutions and certainly before governments and regulators feel comfortable giving their final blessing. And so I do think that it has obviously been a long time that the SEC has been looking at this space. I know from a lot of the publicly submitted information as well as the response from the SEC that there is a group of really intelligent and highly informed people within the regulatory bodies of sort of the US financial framework looking at these issues. And I think the idea of taking a little bit longer to make sure that it's done and it's done correctly is probably a good thing for the space in the long term. So I wish I could predict when we would see an answer on that. Unfortunately, I do not, other than my own speculation, of it coming at some point in the future. And I think both ourselves and Fidelity are presuming that someday there will be, SEC action approving such a change. To the second part of your question, I think that regulation really is a good thing for this market. For many of us that have sort of been in this space for a number of years and have been subscribing to this ethos of decentralization, I do think that there's been an overemphasis on regulation being a negative for the industry, when the reality is this regulation provides a very stable base by which larger players, institutions, publicly traded companies alike, feel much comfortable trading trading and playing in the space. And so, while we don't know when it's happening, we can presume that there are the right people in places in the U.S. government looking at these issues and really trying to promote innovation while ensuring that the appropriate protections are in place. And so I think over the next few months and in coming years for sure, we will certainly see more progress on this particular subject.
But do you see like all this 8, 9, 10 ETFs that have filed with the SEC coming to the market at the same time? Does it make sense to have, such a huge number of Bitcoin ETFs trading at the same time? How do you see how is that going to happen?
Well, so I think that's another great question. The reality is, it's certainly not the case, the role of the SEC to be determining how many of something there are or aren't. That's, of course, more of a business case that companies like NASDAQ and like Fidelity and like many others would have to make about what the competitive landscape looks like. There's obviously tens of thousands of indices. Many of them are not all that different. And at the end of the day, it's competing for trying to create tiny bits of sort of alpha and edge in producing, higher quality products. And so I think that's what most institutions like NASDAQ are trying to accomplish at present. Now, as to your question about whether or not a single asset Bitcoin ETF or single asset Ethereum ETF would make sense if there was about 10, 20, 30 of those, it probably would be the case that there would be some distribution of assets to a few of the predominant players in that space, with maybe some smaller ETFs that have some advantages, whether it be on a cost basis or advantages on some jurisdictional basis, for example, might open up the door for there to be many of these. However, I think from what we've seen, it's probably safe to say that the first entrance into this market will likely capture a pretty sizable share of the early market available to this particular allocation, and that could have long-term advantages for sure.
Yeah, that's what more or less what we expect to happen with the hashtag ETF that we just launched, right? That being the first, they will probably have a competitive advantage over other ETFs. Turning to Josh. Josh, Fidelity is well known in Brazil as being one of the 3 largest fund managers in the world. We also know that Fidelity has a large brokerage platform as well. But people don't know very well what is Fidelity Digital Assets. And we talk about milestones in the previous questions. And certainly the creation of FDA was a milestone for the crypto world, right? Could you explain us a little bit what is Fidelity Digital Assets? What do you do? What type of businesses you are carrying in this platform?
Definitely, and nice to meet everyone, and thank you so much for having us here. It's an exciting day, week, for sure. So Fidelity Digital Assets was launched in October 2018, but our inception actually predates October 2018. We at Fidelity have a group called the Fidelity Center for Applied Technology, and that group has a number of different business units or research groups that look at things like blockchains or artificial intelligence. And we understood pretty early on that there was this sort of pent-up demand to provide services around digital assets. And so we started experimenting early on. We started mining Bitcoin in 2014. We started allowing employees to purchase things, purchase lunch in the cafeteria with Bitcoin. And we started accepting Bitcoin as a form of charitable donation and through one of our charitable arms. And so it was sort of this own narrative, that we had where we were mining Bitcoin, we were transacting in Bitcoin. We didn't have any way to custody it, to trade it. And in 2015, the time frame where we were running these experiments, there really wasn't, there wasn't really an evolved institutional landscape like we have today, right? Like if you went to someone in 2015 and you'd say, NASDAQ, Fidelity, some of the largest banks in the world are involved in this space, most people probably wouldn't believe you. And so it's been a pretty rapid growth and development since then. But really what we did is we launched in 2018 a business unit out of our lab, out of our research effort into a commercial business line called Fidelity Digital Assets, really to meet the needs that we felt when we were exploring crypto and exploring early days of experimenting with Bitcoin. And so the services we provide today are around the custody and the trade execution for large institutions that want to access the marketplace, but they want to trust their custodian, with holding their Bitcoin, and they want to access regulated spot markets so that they can, either buy more Bitcoin or sell Bitcoin against US dollar. And that's essentially the service that we have today.
So on the custody side, would you say that your client is mostly institutional, or also the retail clients can benefit and can have custody of their digital assets, of their crypto assets inside Fidelity?
So to date, it's been institutional only, but there are some sort of there's some sort of nuance around that. So when we first launched, a lot of our demand was coming from family offices, ultra high net worth, sort of folks who could make a decision around investing in digital assets without relying on the decision making at a board level or at an investment committee level. So a lot of early tech founders, a lot of early hedge funds, a lot of early passive investment vehicles. These became sort of our early clientele. And as we scaled on from, I'd really say in the last year or so, 2020, I think, was an explosive year in the growth of digital assets, where corporate treasurers started allocating part of their corporate balance sheets to Bitcoin. Insurance companies were allocating through their general accounts. University endowments, U.S. university endowments, started allocating part of their endowment funds to Bitcoin. So it's really been an upward trajectory in the types of clients we serve. To date, it's mostly institutional. We launched actually today a program where we will act as sub-custodian to other banks. So if a bank wants to use Fidelity digital assets and white label our technology, we support those sort of efforts as well, but not yet for retail. And so, that's been something that's deep, certainly deep within our minds, and something we're focused on. We don't have a product for retail at this time. It's an institutional only platform.
All right, but I understand that you are already allowing your institutional investors to use crypto as collateral for loans, right? So essentially to leverage based on crypto, right?
Exactly. Yep. So there's been, Bitcoin is a really interesting, if you're looking at the attributes of it from a collateral management perspective, it has a 24/7 mark to market. There are capital gains associated with selling Bitcoin, and it's very easily transferable. And so we had a lot of investors coming to us who are early holders of Bitcoin saying, hey, we want to use our Bitcoin for working capital, or mining firms, for instance, coming to us and saying, hey, we're sitting on all this Bitcoin, but we need to pay our power supply, and our power supplier doesn't accept Bitcoin. They accept US dollars, or they accept, another form of fiat currency. And so there's a really interesting, compelling use case that we started seeing where our institutional clients want to gain exposure through using or financing against their Bitcoin holdings. And so we also have a platform. It's really just an extension of the capabilities of our custody platform. So we're safeguarding the collateral, but we're working with both the secured lender as well as the borrower to help facilitate the movement of those assets during the time of the loan. Of Bitcoin, for instance, appreciates significantly, and someone needs to take margin off the plate, or if they need to provide contribution margin during the length of a collateral arrangement, then we have the ability to accept it. So it's allowing our clients to be more nimble in how they're using the assets that they hold.
All right. Yeah, that's super exciting. I can't wait to see that happening in Brazil as well. Steve, let's talk a little bit about Coinbase IPO, right? Since it was actually the first direct listing on NASDAQ. How important was Coinbase IPO for the development of crypto in the United States as a whole? And how do you see the fact that Coinbase has such a high valuation now? How do you see the room for more integration between, let's say, the crypto exchanges and the regulated exchanges, eventually even some sort of consolidation between the two of those?
definitely. So I think there's a few different categories and sort of ways we want to look at that first question about Coinbase and their direct listing on NASDAQ. I think it makes a world of difference in terms of the credibility of this space when it comes to what's been lacking over the last few years in terms of institutional acceptance is truly a watershed moment where institutions that have been building up the infrastructure within this growing asset class have sort of gained a seat at the grown-ups table, so to speak. And I don't think there's any other example that a company could make that's more compelling than that, than to go public in a successful offering on a major global exchange. And so on many dimensions, Coinbase going public, I think, is a very compelling signal to the market that first and foremost, this space has grown up and is now at the level of where other major global publicly traded companies are at. And when you look at, to your point, the valuation, I think that its initial very high valuation to the market gives a really strong appetite and view of what the future earnings potential of a company like Coinbase is. Now, of course, there was some volatility initially in that launch, and direct listings tend to be known for that. But I think the core of the story is that a large institution that's been building the infrastructure of this space for a number of years, making that leap to become a publicly traded company with transparent reporting, with quarterly obligations to shareholders that are outside their private investors. And I think most importantly, a higher threshold of standards that they now have to comply within to ensure that they're meeting the standards and obligations of a publicly traded company. So I think it's an enormous signal to the market. As for your second question about what this means potentially as we move towards larger global integration of exchanges between what are considered to be more conventional or traditional asset classes and new digital assets, I think is still a pretty wide bridge. And I think the main reason for that is the current existing financial system that we have today has, quite literally taken decades, if not the greater part of the last 100 years, to mature into what it is today. And many of the rules, regulations around custody of those traditional assets, around standards for trading, standards for settlement, rules on reporting requirements, are very well established and highly tailored towards those type of instruments. With digital assets, as Josh was alluding to, there's a higher degree of programmability. There's a significantly different composability of how assets can be allocated, how they can be moved, what they can represent. And so from a regulatory standpoint, there's a much larger hurdle or burden from a decision-making and sort of rule-making perspective as to how to create standards that this new digital asset class is going to play in at a more regulated and more controlled level. And the important part about that is because there's a more complex rulemaking path that needs to be completed, I don't believe that we're probably close to having truly integrated exchanges that can facilitate the exchange of all of these assets until some of these really hard problems get solved and the comfort level among regulators becomes a little bit more confident and higher than it is today. And I think looking at this from the perspective, it's one hurdle at a time. And in the conversation around ETFs, I think that's probably the first sort of target in the short term that would most likely need to be approved before we can start getting towards a more globally integrated financial network. Though I do think that someday we have the potential to end up there.
Okay, and in terms of, let's say, potential crypto IPOs, Coinbase was really the one that everybody was expecting, right? Or you see anything else related to crypto that could come with an IPO near term?
Well, I think maybe this is a good question for both Josh and I to answer with giving a broader view of the space. There are certainly many companies out there that are earning a lot of money and earning the type of money that would certainly be commensurate with a publicly traded sized entity. At present, the majority of these entities are exchanges. And so when you look at that particular slice of the marketplace, there probably is a larger hesitancy for those types of entities to make themselves public, because it really does exponentially increase the scrutiny and the challenges that they would have to abide by being more publicly open. And so from the exchange side, it's hard to predict if any of these companies will make a move to become public. Speaking of course of the larger retail exchanges, though I think certainly several of them probably are positioned to potentially move down that path. From the point of view, and this is where I'd love to hear Josh's view as well on this, of the blockchain infrastructure type of companies, there's some interesting players out there that probably have the potential and sort of the current revenue to go public. I should probably avoid naming specific companies because that could potentially indicate that I know something, which in this case I'm separated from that line of the business. But what I would suspect is that certain companies that are doing on-chain analytics and analysis, in particular if they're doing so with government agencies, probably are positioned to potentially make that consideration. And then some of the large wallet providers that do some exchange trading, but also have started to dabble with doing some collateralized lending and borrowing, would also, I think, be candidates to consider this in the future. As to when that happens, that's something that the market just has to wait to find out.
Steve, I'd add on the one infrastructure, sort of segment that I think could really benefit from the public markets is the mining space, where I think every other element of the digital asset ecosystem can benefit from venture funding. Raising a Series A or a Series B, $20 million US dollars to $50 million US dollars normally in size, I think is enough capital for a lot of these firms to get up and running, given a lot of the technology is open sourced, a lot of it's finding market fit and integrating your product. And so for startups in the crypto space, you can be relatively nimble and launch without a huge overhead in terms of capital. Mining is completely different. You need upfront capital to purchase the equipment. You need access to cheap electricity. You need access to a hosting venue, and a lot of these companies are actually seeing access the public markets through the SPAC market. And I think we'll start to see, I think blockchain infrastructure companies, mining companies that are producing the parts of the supply chain that are being integrated into the mining equipment, the ASIC hardware and the GPU hardware. I think we may see some activity in that space as well. I would not be surprised, just given how helpful capital is to the mining side of the business.
Any names specifically that you would mention, Josh, in terms of companies that would be closer to the public market?
No names to mention, but certainly, I think for most of these mining companies, there's going to be opportunities to grow in the public markets, given how successful we've seen some IPOs and SPACs this year. So I no names, but I certainly wouldn't be surprised if we see more do that this year.
Josh, one question that I personally have. I know you are not close to the brokerage side of Fidelity, but how in general are financial advisors in the US dealing with crypto, or if you cannot say generally, but at least the ones that are working with Fidelity, are they actively recommending crypto to the clients' portfolios, or the clients still do that more or less on their own, and it's not part of the, let's say, attribution of the average advisor in the US to talk about crypto, because there is not many places for you to custody, etc. It's probably a bit more difficult for the advisor to talk about that. How is that working in the United States?
Yeah, so we work with various advisors or advisory groups, and some have taken a really forward-thinking stance and said we're going to allocate X percent of client portfolios to Bitcoin. And so we'll work with clients who onboard, 50, 100 client accounts. And of those 50 or 100 client accounts, they're all allocated based on their percentage of assets they own to a number of Bitcoin. And so certainly, there are some advisors out there who I would dub as really, on the cutting edge of this, that have thought of ways to gain exposure not only just to Bitcoin, but for other digital assets as well for their customers. So that definitely exists. I'd say the vast majority of advisors are reacting to client demand, and you're looking at the generational turnover of wealth in the United States is starting. And the products that the younger generations are demanding are digital, and they want crypto as part of their portfolio. You can see it, and the trends are very obvious in terms of who's making announcements these days in terms of supporting digital assets. You have PayPal, you have Square, you have Robinhood, you have Wealthfront. These are all companies that are majority millennial used. And so I think a lot of those companies are reacting to client demand. I'd say on the advisory side, most advisors are going to be reactive, and they may have some clients who, in order to maintain and grow that relationship with that client, they may onboard with someone like us to specifically handle a few edge cases. Holistically, I'd say, we're still getting there as an industry around supporting the asset class and having advisors be comfortable talking about it. Because if you've gone to, if you've taken the CFA, and I know there's a great program, there's a great, program with part of the CFA now that talks about digital assets. But if you've gone down the path of being able to recommend assets to clients and built your whole career around this, Bitcoin and digital assets were not a part of that curriculum. So there's a big learning curve that people have to go through, and we're seeing that start to happen. We're seeing the education begin at, not just we want to learn about digital assets, but we want to learn and we want to get a few clients into this space, a few of our Cavalier clients who really have been demanding this of us, and then we're going to follow on with additional clients after that. So I'd say that's the path that most folks are going down. It's finding the right model for a few clients and then building that out over time as more people start to demand it, and as their models change and they look at Bitcoin or other digital assets as a way to enhance return or minimize volatility or whatever their end goal for their clients would be.
Yeah, that's interesting, because our recent experience with the hashtag ETF here in Brazil was very interesting in this sense that it was probably the first time that some financial advisors, right, linked to Genial, linked to other distributors, were talking about crypto actually, right? And it was interesting to see that the message seemed to have gotten through, right? Out of this 30,000 investors on a hashtag ETF, many are new to the crypto universe. And the interesting thing, they came with like small size tickets, right? Really like testing the water, trying to understand a bit better what they are buying so that they can, later on decide what is the right size for crypto in their portfolios, right? So that's why I was curious to see how, advisors in the US were dealing with that. Let's talk a little bit about tokenization. Steve, is it a risk for the regulated exchanges that some shares start trading outside of the exchanges under the form of tokens? How do you see that? How close we are to that happening in the international markets? How much regulatory obstacles this tokenization will face? Actually, I mean, you can reply from the point of view of NASDAQ, but I would like to hear a little bit Josh's views on that as well.
It's a really great question, and for anyone in the audience who's maybe not familiar with this, some exchanges around the world, I'll use FTX as an example, have actually begun trading effectively synthetic token-based equities, but in the form of actual, on-chain tokens. So other actors outside of, the traditional larger exchanges have already come up with their own ways of doing this and using price oracles and a variety of other techniques to be able to track price, and then of course create their own settlement mechanisms. And there's some complexities about how they've made that all work, but the reality is that when it comes to tokenizing equities in that sort of off-market capacity, there hasn't been anything legally, regulatory, or otherwise, at least in the jurisdictions where that's been done, from preventing that sort of activity. Now, from the standpoint of NASDAQ and decisions we might make strategically around tokenizing equities or more traditional assets in the future, it actually becomes more of a business conversation than it would seem. And what I mean by that is the economics of products currently traded on NASDAQ are incredibly efficient on a scale that is really hard to comprehend. Our matching engine is truly a marvel in its ability to actively fill orders. And from the standpoint of the speed and the cost and the efficiency at which that whole system works, the current infrastructure for trading existing products is actually quite developed from purely just the technology standpoint, to where unless you're talking about building different products on top of it and doing some more unique things, there's a lot of practical arguments to be made that it would be more cumbersome to try to replace that infrastructure for something that's working exceptionally well. And then you layer on top of that all of the regulatory compliance questions and the standards that exist around settlement. And a lot of that is done through sort of the third party, the large global third party settlement houses. And that infrastructure has taken decades to build up and works exceptionally well. Now, from the standpoint of thinking about, and really I just bring that up because I think you have to look at any new technology from an economic decision standpoint of what's worthwhile to try to do with it, as opposed to trying to do something better that's already being done well. Find those use cases potentially where tokenizing assets or products that either haven't been done yet or can be done in a substantially better way is really the best fit for this sort of technology. And especially because as that occurs, some of the regulatory frameworks that we're all waiting for will start to be put in place and evolve alongside those newly traded products or derivatives of existing products. And so really the stance there is that if you're looking for some unique use cases around what assets would make sense to tokenize from conventional markets, you would want to look at really inefficient asset classes. And there are some out there where the margins are particularly high because there is an asymmetry of information or just poor order matching. And so when you look at swaps, derivatives, and that sort of thing, there probably is a marketplace for tokenizing some conventional assets in that fashion. But in terms of the existing infrastructure, as much as I would love, as a big believer in this technology, for NASDAQ and all of these global exchanges to tokenize existing equities, there's a lot of economic reasons why it's probably not that pragmatic to do so for the time being. That said, I still agree that there's immense opportunity to go after some of these new sort of asset classes. When you look at new types of bonds around ESG and some other areas there definitely is an immense opportunity to capture some of those new markets with this technology.
Josh, you want to comment on that?
Yeah, I can just say, we are, I'll give the Fidelity view and then I can give you my views as well. So Fidelity is a Bitcoin only custodian. We do believe in a future where, all assets will have some form of tokenized version and they'll live on a blockchain and be exchanged in that way. But I think Steve made some really good points around why it's just not practical to predict around when that could happen. I think what's more practical is we're seeing this already play out, right? I think what we've seen from in the last 2 years, the growth of stablecoins as really like one of the best use cases we've had to date of a tokenized asset where it's just dollar backed or it's fiat reserved. Most stablecoins are either going to be one-to-one fiat reserved, or they're going to have some sort of algorithmic mechanism that pegs them to another asset's price. And we're seeing nearly, we're seeing trillions of dollars essentially be printed on top of these infrastructures, so that you can have something that settles alongside a digital asset. So the example I give is, if someone wants to trade Bitcoin, there's still a cash side of that transaction. So whoever's trading Bitcoin is still taking on the commodity risk of the price until settlement actually happens, until the orders are matched and settled. If you have a stablecoin, then you can really just use tokenized dollars to transact versus that Bitcoin. You don't have that outstanding counterparty risk. You don't have that outstanding settlement risk. It just makes transacting in digital assets that much smoother, because the network rails that we have for cash are not as fast as the rails that were built for digital assets. And just quickly on other areas of tokenization that not necessarily we get a lot of demand in from a client perspective, but certainly are interested in, at least in terms of how we view the world. The first one is decentralized finance. So DeFi has been a really novel development in the last year and a half, where we're looking at sort of disruption of the middleman in a financial transaction and relying on the code to facilitate yield generating activities to match peer-to-peer loans. It's just been very fascinating to watch that space develop. I think there's some insularities and some sort of it's the user experience is not ideal yet, but that's really interesting. Just the amount of assets that are locked in DeFi protocols, and we continue to see that grow. And then on non-fungible tokens, I think using a tokenized real-world asset as a way to extract new value for creators is really important, whether that be digital art, music. We're basically coming up with ways to democratize funding for artists and for athletes and for other folks who create something of value of whether that be music or digital art, and provide authenticity and allow a way for those types of assets to be traded. So I think there's a lot of interesting things happening there. Certainly, seeing the price of digital art increase, and traditional auction houses now allowing, auctioning off some of these pieces. It's just been very fascinating to see that market develop, though I don't think there's a strong institutional demand just yet for participating.
Okay, yeah, this is certainly fascinating. I would have a lot of follow-up questions on that, but we don't have time, and we need to open for at least one question of the audience. So I don't know if we have anyone on the line to ask a question. Oh, here we are. Hello.
Hello, good evening. So I had one question. During this discussion,
Could you just say your name, please?
Hi, I'm Isabella. During this discussion, you have spoken about the main challenges in adapting stock market infrastructure for blockchain adoption. Which one factor do you believe will be the most challenging as this market evolves? Technology, security, or regulation?
Who wanna take first?
Sure, I'd be happy to go at that first. So, Isabel, it's a great question. I do think that each of those areas you identified do lay out some degree of challenge. In my view, I think some of the technological challenges and sort of the custody challenges are quite solvable and within our grasp. And in many ways, I think the solutions already exist. They just haven't been applied. That said, you can't underestimate how hard it is to update legacy infrastructure in systems that have been dependent on for decades to be able to, effectively, be the rails upon which our financial system works. So those problems are not without heavy lifting. But I actually fundamentally, of the three, believe that the regulatory challenges might present the biggest obstacle. purely because the pace at which this particular asset class is changing is a nightmare for anyone in a position writing laws or enforcing laws and rules, due to the fact that the market is 24/7, 7 days, 24 hours a day, 7 days a week. And within that time period, you have an open source global community of developers, programmers, entrepreneurs who are constantly trying to create new incarnations of what can be done in this financial system, or as Josh alluded to, this sort of creative global system of IP ownership or property ownership in the form of non-fungible tokens. And so I think that, largely speaking, traditional finance is going to start to move over and solve some of those technical challenges. You already see entities looking at how they could settle in stablecoins, for example. And so I think that force is going to be pushing, but it's a bit like, to use an analogy like driverless cars, the technology exists. All of us could be effectively being driven around by these vehicles today, more or less, minus some tweaks that need to happen for it to be truly at the level where it's 100%. But ultimately, that's probably not going to occur until the world becomes comfortable with that. And the world becomes comfortable when governments, jurisdictions, and society ultimately become comfortable through very clear rules and regulations. And again, the nature of how quickly this changes presents challenges of how accurately those rules can be developed and then maintained over time. So I genuinely think a big part of that bridge will depend on some of the regulatory developments that we see in the coming years. But I think it's a great question.
I can take the bait and also answer on behalf of regulatory. I'll do so. I should caveat, I live in Washington, D.C., so a lot of this stuff is happening all around me. But really, there's just a lot of unanswered questions. And a lot of those unanswered questions have to do with, what is, like, we don't, in the United States, for instance, we have a patchwork framework of state by state regulations around money transmission. Money transmission as a digital asset custodian or as a digital asset exchange is much different than, let's say a fiat exchange or capturing data on, someone who's operating a cash exchange. So there's just a lot of unanswered questions. I think that hopefully we'll get clarity on in the next couple of years. I think additionally, I mentioned before decentralized finance. This is it's a counterparty-less system, right? There's no central counterparty. So how do you wrap your head around, is it actually an exchange? There's just so many questions that, regulators are going to have to grapple with. And I think they probably have the hardest position to be in right now because they don't want to force behavior. They want to watch the market mature and put in regulation that actually help guide things in the right way. And so now, you guys have the ETF in Brazil, there's ETFs in Canada, but all eyes now turn on the United States to see what's going to happen there. And we have a relatively favorable, we believe, SEC commissioner with staff who understand this. Again, Gary Gensler was previously teaching a course at MIT about Bitcoin and digital assets. And so, there's going to be some dialogue. And I think right now the people who are in charge are capable of having that dialogue. And I think that's going to certainly change the course. I just think the pace of innovation, Steve, to your point, is going to outpace the way at which regulators can keep up. And at some point, there's just going to need to be much closer dialogue between the two. But having said that, we think look at the Commodities and Futures Trading Commission, for instance, in the US. They have a sandbox. You can go to their sandbox with an idea. You can test your idea out with them. And if they see any issues with it, you'll learn through that process. And that's not, I think, taking a very favorable approach towards allowing people to innovate without creating or just not allowing that process, that creative destruction sort of process to happen. So regulation is going to be certainly the laggard, but something that we all, hope will catch up in the next couple of years.
That's great. Josh, Steve, I want to thank you very much for your time. Unfortunately, we ran out of time. I had a bunch of questions left here, but unfortunately, I mean, we got to our time and we have to let you go as well. But again, thank you very much. I think for many in our audience, it was the first time they had a chance of hearing someone from large institutions in the US talk about crypto, and I'm sure that they learned a little bit about what to expect for this asset class going forward. What are the developments that can happen in the US going forward? And we know that whatever happens in the US will end up, impacting the rest of the crypto world, right? So thank you very much for your time. It was a great pleasure. And now pass back to Denise, que vai terminar o seminário de hoje e concluir com as palavras finais. Thank you very much, guys.
Likewise, thank you.
Thank you.